Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. First, the headlines. It's a lackluster day of trade on the June series expiry day. The Nifty remains in a narrow range above the 11,870 mark. Tech Mahindra is the top loser on Nifty index today. The stock is down for the fourth day in a row. Traction is seen in auto stocks. The Nifty Auto Index is the top sectoral gainer, with all components trading with gains. And Mindtree is down for the sixth straight day after L&T acquired a controlling stake in the company, and also reports suggesting that MD and CEO could resign. Good afternoon, Neeraj. Well, third straight day of gains coming by. I think we're seeing some bit of resistance around the mark of 11,900.
Yeah, but banks are powering their way ahead, Navneet. And yeah, you're right. Maybe some resistance there, but banks certainly doing very well for themselves. Another 0.7% higher in trade. It's really the Nifty Bank, which also, of course, has come a little bit off from the highs of the day, but still looking very robust and looking set for more gains. Maybe 3 days on a trot now. We've had banks participate. Day one was Reliance, but day two and day three have certainly been banks. Bring up the turnover on the expiry day. The cash market turnover will be interesting. You expect the FA turnover anyways to be high, and no surprise there. But the cash market turnover too at 23,000 crores is a lot higher than what we've seen at this time around almost any given day. So maybe we'll nudge closer to the 35,000 crore mark on the NSE cash. And the market breadth should come up on your screen for a moment. Yesterday was a big day for market breadth. Today even better in that sense, because it's opened wide and it stayed largely wide. It's come off a little bit from the highs of the day, but still better than 3:2 in favor of the advances. The heat map on the Nifty and show you what's moved and what's not. Well, Tech Mahindra, the headline stated 2.5% lower. IT is taken a bit of a backseat today because I can see Wipro and HCL Tech amongst the losers too. And Reliance Industries, after that first day of an uptick, which was on Tuesday, yesterday and today, has stayed soft. But what's done well, Indiabulls Housing Finance, and then a clutch of auto names. So Tata Motors, Mahindra and Mahindra, Eicher, Hero MotoCorp, Bajaj Auto, almost without exception, everything on the index, even Maruti, is up in trade. So auto is certainly packing a punch. Maybe the broader of the spectrum too has that feeling. And HDFC Bank from amongst the heavyweights is doing well. But rate sensitive certainly piloting ahead. Bank Nifty quite the star performer today. What about the broader markets? They now have autos shown the performance there too.
Actually, Neeraj, before that, just want to pull up an Axis Bank to see what that stock's doing, because there's a piece of exclusive news about them raising some funds. The stock has actually plummeted from the peak, so you've seen this big cut coming in. They're looking to raise about $1.3 billion through share sale to institutional investors. The initial reaction to that is not a great one, though. Stock's at about $7.95. Remember, yesterday you had a few of those brokerages turning positive on Axis Bank. They're probably putting it in line with what an HDFC Bank is, probably reaching to that point. But so far, I don't know whether it's on this piece of news or not, but you've seen that big crackdown coming in.
This would $1.3 billion would be a dilution of maybe 6-7% if I'm not wrong, looking at the current market cap of Axis Bank. So nothing too dramatic, but yeah, important piece of news. This is not small. This is pretty reasonably big. And if indeed, Devina, they go through with this in the next couple of months, then it makes any financial institution on a price to book valuation even better on that perspective. So interesting piece of development.
All right, we'll watch out for Axis Bank through the trade today and get you some more perspective on the same. But just moving on then and quickly taking a look at what's been happening in the broader market space. A few stocks to lay your eyes on. First off, being Godrej Properties. The stock yet again in today's session hit intraday life highs. The stock now is trading about 3.5%, more than 3.5% higher. Ujjivan Financial Services, 1% higher. Remember, we spoke to the management in the morning, and they clarified that they're still evaluating the IPO option on the back of the fact that, this on the small finance bank listing. Cafe Coffee Day, with some interest coming in from Coca-Cola, reports suggesting that, and the stock has taken a good liking to that news, and it's up about 4.5%. Other stocks on the move, big gains seen in Shriram City Union Finance, stocks up 10%. HEG morning session opened about 1.5% higher. That's increased to about 4.5%. And Prestige Estates also from the real estate pack doing well. Remember, we've been talking about how the Bangalore property market seems to be hot right now, and therefore you will see some interest in the likes of Prestige Prestige and Soba. Other stocks, Dish TV is up about 3.5%. Then you've got Supreme Industries. PVC prices have been rising over the last few weeks, and this is started to be positive for some of these pipe makers. The Supreme Industries on the is up about 4.5% on the back of heavy volumes as well. KRBL is the other one. Losers in trade, Imami continues to grind a little lower. Last 2 days, though, it's taken a respite from the big 9-day fall that it had already seen. Now it's back in the red. Hexaware is down, and Syndicate Bank on the back of volumes as well. Stocks, however, near their 52-week high. One is City Union Bank. 52-week high is about 220, so it's just about 2 odd points away. And SRF, its 52-week high is 3,075. It's at about 3,020, but still higher in trade today. But it's the important June series expiry today, and Navneet is joining in to highlight all the details that we need to keep in mind before the last half an hour of trade. Navneet.
Thanks for that, Divina. Well, the expiry volatility can be seen on the screen. Nifty has given up all its gain. In fact, now we're just sitting with gains of about 9 to 10 points on Nifty. 11,857. Rollovers have picked up just about 62%, but just build up seen on the July futures. That's obvious because of the rollover. And pull up Bank Nifty. Now, remember, Bank Nifty has been outperforming Nifty for the last 3 sessions, and there is some unwinding pressure seen for the June futures, and 30% higher with regard to the July open interest right now. The Bank Nifty has also come off the highs that we've seen, currently at about 30,264. Pull up the volatility index. I think first half of the session it cooled off. Until now, we've not seen any increase in volatility, with markets also coming off. This could be a function of the expiry date that we are seeing on the screen. In terms of options data, your most active strikes for the day are 11,800 put, 900 call, as well as the 850 put. Last 3 sessions, remember, today is the 3rd straight day of gains coming by, and we've seen more of put writing in the system. Where can the expiry take place? We've seen a lot of put writing coming at the 11,800 strike, and on the call side today, 900. We touched that mark very briefly. The index couldn't sustain above that mark, so definitely there is some bit of resistance which is coming there. So expect the expiry to be in that range of 11,830 to 11,900 on the upside. Stock specific, 2 stocks which are trading around their all-time high levels. Divina highlighted SRF. On the future side too, we've seen some bit of activity coming by. For the series, the stock is up about 6%. Shree Cement is the other one, though it's not risen too much for the series, but the stock has been making gains very steadily in the last few trades sessions as well. So for the series, it's just up about 3%. There is definitely long position seen for the July series as the open interest has gone up. Actually, not only that, even the June series till now, it's seeing open interest build up of about 27%. And Tech Mahindra is the other one. The stock's down for the 4th straight day. Weakness seen in this counter. It is trading below its 200-day moving average. Futures indicate that even at current levels, the traders are taking bet on the short side, and the rollovers for this one too look on the higher side. Even the June futures are witnessing OI build up of about closer to 20%. Well, these are the stocks which are in action today. Remember, the 34 stocks which come out of the derivative space. So just want to highlight some data on 3 stocks which are moving out. One of them is India Cements, the other is Jet, and the third one is Canfin Home. Now, this data has been taken from the NSE as of yesterday. There are 4 clients who hold about total 42% of the open interest for India Cements in the F&O space, and for Jet Airways, 4 clients holding almost 20%. For Canfin Home, around 54% of the total open interest is held by 2 clients. This just basically tells you the concentration risk between few hands, and probably because of this, you can see some bit of unwinding pressure coming by in the last hour of trade.
All right, let's bring in the market voice then. Prasun Gajri, CIO at HDFC Life, is joining us on the show this afternoon. Prasun, a very good afternoon to you. What's the call now at HDFC Life in terms of where exactly you're turning overweight versus where you see the risk appetite reducing?
Well, it's a mixed bag out here. Very clearly, I think the market is facing both a certain amount of negative momentum as well as, but at the same time, there are positive signs which are also emerging. So I think from our perspective, it's a bit of a range-bound market. Clearly, on the positive sign is the fact that India is relatively isolated in the global trade war scenario. The interest rate cycle is clearly benign. Inflation remains low, rupee remains stable, and crude, despite everything, is still not a worry for the Indian economy. So given this and the fact that you have a new government in place who will be willing to look at growth as an imperative, that makes people positive in the market. Having said that, this is more the big picture, but if you look more at the micro, I think sectorally we are starting to see, not just right now, but over the last few months, slowdown emerging across various sectors. The NBFC related issues and the after impact of that is still very much visible, and we don't really have the end situation in sight at this point of time on that. So put both these things together, very clearly one would want to believe that this is a market which is frankly not going anywhere. It could be a period of low returns from the next 6 to 12 month point of view. Having said that, given the positives which I talked about, I also don't believe there is anything significantly negative being built in the market. So therefore, we would want to remain invested in this market, not to be out of it. Clearly, but one would want to play it in a slightly different manner than possibly if the growth imperative, especially on the consumption side, was different. So I think that is the call of more of a range bound market, possibly single digit returns over the next 12 months and manage the portfolio accordingly.
Okay. The other one is the private sector banks, one bank being Axis Bank, and not just being stock specific, but aside from the fact that now they're looking to raise funds, within the private sector bank, a few of these names have started to pick up interest in a big way. One, obviously, brokerages have turned very positive on Axis Bank. IndusInd Bank has started to recover post its Q4 numbers. How would you play this space? And if you want to talk about it in any individual bank from within this pocket?
I will not want to talk about individual banks, but let's look at the sector as a whole. Clearly, the larger private sector banks are in a sweet spot. One, clearly their troubles on the asset quality side are behind. They are well capitalized and their ability to raise funds is not questioned at all. On top of that, they are gaining market share. So even if the credit growth is not very high, most of these banks will be able to do pretty well in terms of growth of credit, because the NBFCs are clearly losing market share. The PSU banks still continue to lose market share. At the same time, the pricing power is still with them. And therefore, the ability to kind of make decent margins on incremental lending is also fairly strong. So I think there is a concentration of business which these banks will garner. So at this point of time, and the credit cost over the period of the next 2 years will keep coming off for some of the banks which had these issues. So we remain fairly positive on the entire private banking space. Yes, one would want to be a little bit choosy in terms of which ones, but overall the space looks fairly exciting to us from the next 2 to 3 years point of view.
Prasun, you highlighted the macro environment and keeping all that in mind, and economic slowdown is pretty much pronounced now after we've received the latest numbers, the growth numbers. Keeping all that in mind, in 11,850 where Nifty is trading, it's because a few stocks. So the rally has been polarized because the gains we've seen for stocks like HDFC Twins, Bajaj Finance and TCS, and which have contributed the most. What I want to know going ahead, should investors continue to take refuge into quality where there is more of earnings predictability, because the broader markets, they continue to underperform?
Yeah, fair enough. So I think the point is that over the next 12 months, you would want to take refuge in stocks where the earning trajectory is by and large stable, and people are therefore respecting that and not really bothering too much about valuations. So, but that is, in our view, a little bit more short-sightedness, because that could change. So one would want to kind of, while focus on these kind of stocks, which is quality, because that is what is likely to fare well in this volatile phase, but at the same time manage to have a more diversified portfolio and look for stocks which have corrected, where the earning trajectory is reasonably good and the valuations have come off, but at this point of time market is not really looking at that. Try and identify some of those areas as well. So in our view, it has to be a combination of both these quality stocks as well as stocks which we believe have corrected significantly from the peaks and are looking better from the next 2 to 3 year point of view. They may not necessarily perform in a very volatile market, but as we get out of that, they will do well. So for us, it's more of a combination and continue to maintain a fairly well diversified portfolio across sectors and stocks.
Prasun, stay on with us while we address some important news. Axis Bank management will seek board approval to raise up to $1.3 billion very soon. The private sector lender under Amitabh Chaudhary is set to have talking to potential advisors. Anto Anthony of Bloomberg News joins us now on this exclusive story. Anto, tell us what details are you gathering, and is there any timeline that you've also gathered for this fundraising plan?
That's right. So Axis Bank management has been meeting with potential advisors for a stake sale, which could raise about $1.3 billion. We don't have a timeline as of now, but they have been assessing the kind of interest that a share sale like this could get. Also, we are expecting the bank management to seek a board approval for the share sale as early as next month.
This is something that is obviously going to help in the internals of Axis Bank as well, right?
Yes, this will give a boost to the capital adequacy ratio of the bank. As you know, among the top 5 private sector banks in the country, Axis Bank has the lowest total capital adequacy ratio. So at a time when the shadow banking crisis is worsening, the bank is looking at garnering a better market share and boost loan growth through this capital.
And what would be the mode of fundraising?
It will be a share sale to institutional investors.
To institutional investors. Okay, the complete 1.3 will be through that?
Yes.
Okay, Anto, we'll leave it at that. No, thanks a lot for joining us and taking us through those exclusive details where Axis Bank is considering, in fact, it is talking to potential advisors about the fundraising plans. It is looking to raise about $1.3 billion as early as next month, according to Bloomberg sources.
That's board approval.
Yeah, of course, they'll have to take board approval for the same. Prasun, getting back to our conversation with regard to earnings trajectory, which are the sectors now that one should look at? You already highlighted quality stocks should be the one that somebody should keep in their portfolio. But I want to talk about 2 sectors which have not performed well. One of them is auto and the other is pharma, not just this year. Pharma has been giving you negative returns, I believe, for the last 3 to 4 years. Is it time now to look at these sectors? Are they giving valuation comfort?
Let's talk about pharma first. So I would not look at pharma as one single sector. I think every company has its own nuances, which is true of other sectors as well. But in pharma, I think because each company is at a different phase in terms of the regulatory inspection schedule, what is approved, what is not approved, the kind of business mix each of them has, both in US, India, and other countries. So I would take individual calls on some of these pharma companies. Yes, I do believe that some of these names now are looking better than what they were, but will we go significantly overt on this sector at this point of time? I don't think so, because I think some of the concerns which have been there on this sector continue to persist. As far as autos is concerned, while the stocks seems to have stabilized over the last month or so, one would wait and watch to see what kind of growth scenario and growth numbers come out from these names. It has been very difficult period for these companies, but I don't think anyone has any visibility in terms of when the cycle is going to turn for the better for them. So again, while I may nibble at some of these stocks purely because the valuations are becoming more better than what they were before, but I do not think it is the time again to go significantly overt on the auto sector as a whole, because at least as of now there is no data available to support that thesis. So clearly a wait and watch mode on both of them, but there will be individual stocks within both these sectors which we would be overweight on.
All right, Prasun, we'll leave it at that. Thank you so very much for joining us. Really appreciate you taking up the time this afternoon.
Thank you so much.
Getting into some corporate conversation, Varroc Engineering has more often than not taken the acquisition route to higher growth. But growth expectations have taken a hit as auto markets, both domestic and global, struggle to find some grip. One bright spot could be better margins in the global market, where Varroc boasts of Tesla, Audi and Volkswagen amongst its clients. To help us understand the factors at play, joining us on the phone line is the Managing Director, Mr. Tarang Jain. Mr. Tarang, thanks very much for joining in. Let's talk about the opportunities now, since we're talking about this big open opportunity in the global markets versus the domestic market, where the pain and pressure point has been quite prolonged by now.
Thank you. See, in fact, I would say globally the markets are weak. So in fact, since the last, I would say, 8 or 9 months, globally, I think almost every market is down. Even the North American market, which was growing till about December, has also started degrowing. from January onwards. China degrew last year, since the 80s for the first time. So it's not just the Indian market where we see, kind of pressures, on growth. It's actually global market as a whole, where we are seeing, kind of a degrowth in almost all regions at present. And as you know, the future trends of electrification, shared mobility, connectivity, is not really helping also, growth in the automotive market going forward.
So what, according to you, is going to drive growth for you going forward, particularly considering that Europe forms about 41% of your exposure in terms of markets? If you're saying globally things are looking soft as well, where do you expect the growth to come in from?
So, so we are not, so at the moment, see, what we are doing is that we are looking at market share growth. So we have done very well the last couple of years when we talk about a global lighting business, which is almost 62% of our revenues. We have won in the last 2 years 405 million euros in the FY19, in FY18, and about 462 million euros of new business wins and re-wins, in the last 2 years. And today we have a 4% market share, in the global car market for exterior lighting. And we are looking that, within the next 3 years, they should move up more towards the 5% kind of number. So we are looking in this kind of a situation, we are not really looking at, too much of growth in the auto market, because presently there are too many, macro events at play. You have the China-US, trade tensions, even, disagreements between, US and Euro, new rising fuel prices, new EU emission regulations. So there are a lot of things at play, So the only way out is kind of, market share growth. And to protect our margins, we are looking internally. We're looking at efficiencies, because in this kind of an environment, cash is king. So we are looking at internally operational improvements, purchasing efficiencies. So we're looking more inwards, Of course, keeping also in mind that we need to grow market share at the same time.
Okay. Just one question on how you intend to capitalize on the BS6 norms once they kick in, considering you already have a few joint ventures in place, one with Del Orto, the other one, Herarius in Germany. All of these, how are they going to back the transition into BS6?
Yeah, so so we do see a good growth, through BS6, because a couple of components, there's more of a value add, in the current some of the electrical products we have, and also further, like you said, that we have got these two kind of collaborations, one with Herarius for the catalytic converters for BS6, and other is on the electronic fuel injection with Del Orto of Italy. So these two, I think, product groups and these two kind of collaborations are going to be very critical for us. So we do see actually, irrespective of what the growth in the market is, we will see quite a decent growth, at least on account of the BS6 regulations from January 20.
Hi, Tarang. If one were to look at the auto industry globally, the environment is tepid, which is very clear with the kinds of numbers that we've been seeing. But tell us, for you, specifically in terms of your international business, which did outperform the domestic business in the fourth quarter. After many quarters, we saw the margin expansion coming by. Is there a threat now going ahead with regard to Chinese market due to emission norms or because of trade war fears?
Yeah, so so I think that today one of the most important events which has to be resolved is the China-US trade tensions, because of which the sentiments are quite down, and both the markets, whether the US or China, they're both suffering, and because of that there is, of course, a kind of a trickle-down effect on the other regions of the world. So I think that's one single most important, I would say, in my view, factor in the growth not really taking place in the global car market. So where we are concerned, I would say that yes, the fourth quarter was good. Normally the fourth quarter, Jan to March, is always the strongest quarter from a point of view of revenues and margins. To be honest with you, this first quarter also we have not seen much of a growth, because China, which we were expecting to grow better with some resolution between the US, China Trade pact, that's not happened. So China remains weak, is one of our most profitable markets as such. So therefore, I'm saying that today, we are, though the markets are down globally, including India, but we are going to see a small growth. We're seeing a small growth, at least for ourselves. Like India is also down 10%. You see April and May, but we are still a little bit up. So the thing for us is that, yes, whatever the growth is, we can't control our sales, but we can definitely control our costs, and our cash flows. And that's something what we are working on internally at the moment. But of course, at the same time, new business wins are very important. So we are winning new business. We have the confidence of our customers, both globally as well as in India. In India too, TVS is a new customer for us. So I think we're doing pretty well on that front, to grow our market share, cross-sell our products. So those kind of things are happening very well for us. So we feel pretty confident, in the sense from the point of view of our future growth going forward.
Tarang, the guidance given by company for FY20 for both domestic as well as international business is 10%. You've already highlighted Q1 has not been that great. So are there any chances of not meeting the guidance? Can the growth be sub 10% as well?
So, we have to see. So, yes, talking about so far, yes, we're not seeing the kind of growth we expected. But we just cannot write off the whole year because, there's still some open points like what I mentioned, China, US, India too. We are hoping, though of course we're not very sure whether there's going to be a stimulus, through GST, for the auto sector. But also if it's not there, we're looking forward to the season time, October. We do feel the season will bring in some kind of growth this time. There may be a BS4 vehicle buy. So we are looking at growth, and also the BS6 components when they kick off in the last quarter of FY20. So we are going to be looking at a good growth. Yes, I do agree, that the first, so far, we have not seen much of a growth, though of course, though the market is down, we are not at least down, we are at least up, as a whole.
Okay, certain plants, Tarang, of the company have been making losses. I believe the Brazilian and the plant in Morocco, we've seen losses coming by in the last few years. So what's the status there? And also you highlighted that you will be looking to curb on the cost in order to sustain the margin growth. And the company was also looking at backward integration. What's the status of those plants? Can we expect them to break even in the current fiscal?
No, so see what happens is that the plants like Brazil and Morocco, see these are new plants, and what happens is there's a 2-year cycle, for a lamp development, and we have to be ready for SOP in the global markets almost a year before. So we start investing, before. So our investments, come in place in the global markets we start investing almost 1.5 to 2 years before SOP. So I don't really see, we're not going to see, sales happening to a great extent this year. But yes, from 2021, we will see both Morocco and Brazil, and some of the newer plants, this thing coming into profitability, but not this year. But having said that, we still expect to kind of grow quite well, our margins in the coming year.
Just one quick question, Tarang, before we wind up this interview.
And just one more thing on the backward integration. So one more reason where we expect, a better profitability from the year FY21 is that we are backward integrating into the electronic space for our lighting business. So that's extremely important. So almost about 1/3 of our electronics buy will be manufacturing in-house, which will give us, almost a 10% extra margin. Of whatever we were buying today as assembly, and we do the assemblies ourselves, we do get an extra margin out of that, which will help our overall profitability from FY21 onwards.
All right. Would have really loved to continue chatting with you, Tarang, but I think we're completely running out of time. Thank you so very much for joining us this afternoon. Really appreciate your time.
Thank you.
All right, that's the management of Varroc talking about business opportunities globally as well as domestically. The stock's not doing a whole lot much though, but recently there was a coverage initiated by Centrum as well on the stock. Moving on, nothing can beat the combination of a hot pizza and a cricket match. I think we should ask Neeraj that. But Motilal Oswal's channel checks on Jubilant FoodWorks reveals that the World Cup may not be helping sales as expected. Agam Vakil is joining us on the other side to discuss the key highlights of this. Agam, over to you.
Well, Devina, you have that correct. While there has been some noise, according to Motilal Oswal, it's not been a roar, given we haven't had as much traction seen in Jubilant FoodWorks with the Cricket World Cup coming through. So this particular note is on the channel check done by Motilal Oswal on the kind of observations they made with respect to Jubilant FoodWorks. Firstly, they maintain a neutral with a price target of around 1325. And they did say that overall demand scenario is not looking buoyant. In fact, the dine-in demand remains tepid. And while delivery proportions has been increasing in QSRs overall, well, it's not been up to the mark. And that's also largely on account of the fact that the monsoons haven't come in. The reason here is that when it rains is when they start seeing higher deliveries. And that is something that's not playing out. So, well, what do you know? The monsoon is also working against QSRs at this point in time. Based on this, they are expecting subdued same-store sales growth, at least not up to the mark in the first quarter. And they are suggesting that the first quarter is unlikely to be very different, despite the fact that we have seen the Cricket World Cup, and not the best of pictures painted by Motilal Oswal when it comes to Jubilant FoodWorks.
Okay, thanks a lot for that, Agam, and I second that, third that, probably throwing a drink or two out there too. But yep, a hot pizza.
But you anyway is not a client. You're quite a health conscious.
Yeah, they make healthy pizzas though. At least they claim to do that. But yeah, let's see if the sales go up. During the IPL season, the sales definitely move up in trade. Watch out for Jubilant FoodWorks in trade. Speaking of Jubilant and speaking of the mid-cap space, that index is trading at a 15% discount to the Nifty index. JM Financial has identified a list of 12 mid-cap stocks that offer, according to them, growth at reasonable price, as well as offer value to investors. Sharad Dubey is here to tell us what or which are those 12 stocks. Sharad, good afternoon.
Good afternoon, Neeraj. The mid-cap space has seen a traction and it's almost trading almost 18% to the discount of its Nifty peers. So JM Financial has come out with these 12 stocks, which can, have, will perform better than its large cap peer. The first 4 stocks you have picked up is Bharat Forge, which has set a target price of around 600 rupees, Chalet Hotels with a target price of 400 rupees, Chola Investment Financials for around 605, and Cyan for at 740. Up next, we have Info Edge, which has a buy rating of target price of 2500, Muthoot Finance at 7000, Natco Pharma at 640, and Sanofi India at 6820. Up next, we have Teamly Services with a target price of around 3850, Timken India with 870, V-Guard Industries at 235, and lastly, Westlife Development at around 450. Now, Neeraj, we'll discuss about the 5 stocks which I have picked up. The first one being Bharat Forge. Why JM Financial is very bullish on it, especially this is because of the impact of slowdown seen in the sale of Class 8 trucks, and also the European passenger vehicle slowdown has already been priced in. Apart from this, the operating margins have also increased, and the BS6 pre-buying and scrappage policy will actually aid growth in FY20. Apart from this, even the opportunities will be seen in the defense and aerospace sectors. Next, we are having Chalet Hotels in the hospitality space. This will benefit as it will benefit from the industry upcycle, and as also the average room rate will grow at around 7 to 8 odd %. Also, we can see that the upcoming 3 hotel projects, which is having around 588 keys, and even 2 commercial properties with around 1.12 million square feet of space, augurs well for the company. Up next, we are having Info Edge. Now, if you see Info Edge, the tech spends by Naukri.com will aid the growth in the top line numbers, and also 99 acres is expected to break even by FY21. Apart from this, the business has seen improvement in its margins in the past 4 years, despite increasing spend seen in advertising and development. Apart from this, the 4th stock is Muthoot Finance, where a good amount of traction is seen in the gold loans, and also it enjoys a low-cost model, which has actually added a significant advantage to its peers. And even the asset quality has improved, and the NIMs and the margins are supposed to be, going around the 11 to 12% mark. The last stock we have is Natco Pharma, which has increased its focus in the international market, especially Brazil and USA. And apart from that, it is expected to diversify in its agri-chemical business. And also, there is almost a $283 million opportunity for its for opportunity business. And also, I would like to point out that lastly that the company enjoys a 20% market share in its domestic oncology segment and expects more, going forward into FY20. So I think these 5 stocks were my picks in this list.
All right, thanks for that, Sharad. In fact, we spoke to the management of Muthoot Finance this morning, and they were pretty sanguine about their growth prospects, come what's been happening with gold prices. They also spoke about the fact that they're looking to raise more funds. I think about 1,000 odd crores per quarter is what the kind of funds they're looking to raise via NCDs. Cost of funding has gone up, but that's not a big worry for them, according to the management. 12 months, stock's done about 65%. Muthoot Finance is what we're talking about. Let's bring in our guest then on the show this afternoon. Brijesh Singh, StockAxis, is joining us on the show right now to give us his technical calls. Along with him, we'll be joined by Jagannadham Thunuguntla of Centrum Broking on the fundamental side as well. Let's start off first with you, Brijesh. Your quick call on the Nifty right now and ahead of expiry. Is there any sort of a trade that you would take on an immediate basis?
Good afternoon, Devina. See, no doubt we have been witnessing from past 2 days, Nifty was not able to surpass 11,800 or 11,850 mark. But in today's session, we have seen Nifty surpassing that thing, and even Nifty was been able to touch the resistance zone of 11,950 mark. No doubt from past a week or time frame, we have been witnessing the trend of the change in that trend at around 2:30 p.m. And since Nifty was been trading on the higher side, and suddenly we have seen a profit booking. But overall, if we check it out from a shorter term time frame of the chart, what I have been witnessing is that we would be seeing a pre-budget rally, and chances are that Nifty would be crossing 12,000 mark and might be touching 12,125 or making a new 50-week high. Now, coming to the point of as a trading bet is been concerned, taking a Nifty spot value, anything if Nifty trades below 11,850, one can take a buy call and with the strict stop loss of 11,800 and play for the target of 11,955. Even the target can be extended to the level of 11,985 bet.
Okay, Brijesh, what about your stock specific ideas then?
Good afternoon, Navneet. I have 2 calls, one on a buy side and one on a sell side. Now, the buy call from my side is Federal Bank. When I posted the call that time, it was been quoting somewhere 106 zone, if I'm not mistaken. Right now, the stock is quoting somewhere 108, and if I'm not mistaken, the 52-week high somewhere 109.2 or 9.4. So, if someone wants to play with the trend, present rate at 108, one can take a buy call with modifying the stop loss of from 102 to 104, and target would be same to 112, and it can extend to the level of 115. Time frame to hold the counter would be 4 to 5 trading session, and one call on a sell side is Jindal Steel and Power. After stock, we have seen a pullback, but was not able to cross its previous swing high. So somewhere around 150, the stock was been quoting when I posted. Now, if I'm not mistaken, 149, the stock has been quoting. So one can take a sell side and it with the stop loss of again we have to modify the stop loss with a stop loss of 153 or 154 and look for the target of 142. Time frame to hold the counter would be 3 to 4 trading session.
Okay, those are 2 stock-specific ideas coming from Brijesh for the afternoon. Let's go across to Mr. Jagannadham Thunuguntla to get his fundamental view on the markets. Jagannathan, hi, good afternoon. What's been your reading? We've seen a recovery coming at least for the benchmark in the last 3 sessions, but the broader markets, though they are trending higher, but they still continue to underperform the benchmark indices. Is there anything that you're looking at closely which can be bought at current levels?
At this moment, markets are in a very indecisive kind of framework where no clear cues to take the market either significantly up or significantly lower. I think now a lot depends on how the G20 outcome. I think markets will be watching that very closely, and also the upcoming budget. I think a lot depends on that. I think whether the finance minister can able to do some fiscal respite to stimulate the economy, that will be closely watched. Make no mistake, the monetary policy and the interest rate cuts have not lived up to the expectations to revive the economy. Maybe because lack of transmission, but whatever. But we have to remember and admit that economy is at 5-year low in terms of GDP. So I think now the heavy pulling has to be done by the government in terms of the fiscal stimulus. Already we have done a very good job by bringing the fiscal deficit from 6.5% to 3.4% in the last 7 years or so. I think even in the situation where there is a need for economy to give that fiscal respite, if government doesn't be little liberal, I think it will be of great difficulty for the economy to come out. I think now a lot is happening, and corporate earnings season, which will be starting in the mid of July, I think that also will be watched, which we are expecting that result season will not be that great.
Okay. Let's talk about individual stocks that you're liking now. I mean, while the PSU banks seem to be left untouched over the last few weeks now, considering that earlier on there was a sudden change where some analysts had started liking few PSU banks, talking about how the change is happening out there. Provisions have been front-loaded, things are improving on the balance sheet side. But SBI is one stock that you're liking in particular. They're looking to raise tier 1 capital. That's the news that we have for today. Stock's up about 0.75%. Why do you like this one, Jagannadham?
No, in the entire PSU basket, frankly, we feel if somebody wants to bet upon PSU space, SBI is a clear opportunity. That's a different matter. One can always argue why you have to bet upon the PSU banks in the first place, because when there are opportunities available in the private sector. But if somebody is hell-bent upon PSU banks, and SBI is a clear opportunity. Of course, as you said, the fundraising, at the time of fundraising, whenever that gets announced, there is always a chance that there will be a downtick on the stock. Obviously, the QIP has to come at a discount to the market price. That may give an opportunity for the investors to get in. One is SBI has done a lot of cleanup job over the last 2-3 years. I think the rewards will be paying off shortly. It makes sense any stock to buy on the dips. I think I'm sure if SBI gives that dip, I think that can be a good place to accumulate. And also the stock that we are more keen about is the SBI Life. And the SBI Life, because discussed last time, life insurance is a great theme. We are betting up on the next 10, 15, 20 years kind of opportunity. So SBI Life offers that great comfort after the recent offer for sale. The kind of quality FIIs that they are coming in, that shows that they are here to play for very long term. I think beyond the life insurance space, either through HDFC Life or SBI Life, but there is a lot of money to be made. Don't miss the fun.
Okay. Those are some reasons why Jagannadham likes an SBI. ICICI Bank from the private banking space, that one is soaring from high to high, 441. And just a few months ago, this was touted as one stock within the private sector bank that would really see a great turnaround. And that's pretty much played out for an ICICI Bank. But from a technical standpoint, Brijesh and ICICI Bank now at 441. Is there more headroom left?
See, Devina, as a disclosure, we have recommended to our client. Now, on a daily chart as well as on the weekly chart, the stock is still been trading in a higher tops and higher bottom formation, which is giving a bullish sign. And if I'm not mistaken, this previous 52-week high was 440, and in today's session, we are seeing stock making a new 52-week high. So, if someone is looking for a momentum trading bet, I would be suggesting till stock has been trading above 224 or say 228. keeping that thing as a stop loss, one can look out to buy at the present or any dip somewhere around 235 and look for the target of 256 to 260. And as a positional trader has been concerned, looking for a view of a year time frame, in that picture scenario, the stock has a deeper support at 390 to 395 band. So keeping that thing as a stop loss, one can look out to buy ICICI and play for the target of 525 to 550. So overall, as a short-term trader, as an investor, still the potential has been left.
Okay, some pockets that are doing well, there are 2 or 3 of them. First, I would point out a Radico Khaitan. After hitting those lows of 275, it's bounced back quite admirably. So currently at 324 or 325, the last 7 or 8 days have been pretty strong for Radico Khaitan. Technical factors, and we spoke about them, selling by an HNI, presumably behind the reason behind the stock correcting, now bouncing back. So good going there. The other thing is what real estate as a pack is doing. Kolte Patil, Prestige Estates, even tiny tune like Unitech is doing very well for itself. But across the board, I think we have real estate stocks doing rather well for themselves in the session today. Jagannadham, if you had to choose one of the real estate names, and if it's not meant to be Godrej Properties, what else would you choose?
I mean, frankly, the clear choice will remain Godrej Properties, because we have to carefully understand here is that very few large industrial houses are in real estate. So Godrej is one example. Mahindra is probably one more example where with huge exposure in other industrial businesses, they are coming slowly into the real estate. I'm sure whoever is betting on the property, understandably, we can expect that going forward, there will be a lot of shift from the unorganized to organized, unbranded to branded, into these large houses, because at least there is a guarantee of your house getting delivered because of their balance sheet strength, and there is no risk of the property construction getting stopped somewhere in between. I think a lot of money can be made either on the Godrej Properties. Of course, Mahindra Lifespace developer still in the nascent stage. Still, it has to open up in terms of the aggression what Godrej Properties has shown. But I think if you are betting on the space, be in these very, very popular real estate companies who are in other businesses as well, so that there is firepower to complete your project.
Jagannathan, talking about some other picks, I believe you're also positive on the gas distribution company MGL, which is also facing an overhang of stake sale by BG Asia Pacific. According to SEBI norms, maybe they're open to sell the stake post 1st of July, but fundamentally that's not going to change anything for the company. What's making you bullish in this one? Is it the valuations, because it is trading cheaper compared to other gas distribution companies like IGL and also Gujarat Gas?
Absolutely. I think city gas distribution can be very, very major value creating opportunity in the next 5-10 years, because this government knows that one of the weak links in the Indian macro will remain to be the crude oil prices. So how long we have to keep praying that crude oil price has to remain low for our macro stability? At some point, we have to evolve from that stage and then have to become self-sufficient. That means we have to reduce our dependency on oil, meaning thereby we have to find alternate solutions like, say, gas as one of the solutions to come out of that oil dependency. So government understands that, and that they have pushed the city gas distribution theme very aggressively even in the past. We believe they will be doing it even in the next 5-10 years. And even in the gas allocation priority scheme, they have put the CGD, that is city gas distribution companies, in the top in terms of the allocation. So meaning thereby there is a very good chance this MGL etc. will become huge wealth creators. As of now, it is just trading 16 times in comparison to other stocks which are at much expensive levels, and because of the overhang, as you said, the stake sale is keeping the upsides limited. But we feel it's just a matter of time. Once that stake sale is through, the stock can open up quite aggressively. Be there. I mean, this is not a simple trading move. I'm talking about a more larger picture of next 5-10 years. Keep it in your portfolio. I'm sure rewards will be on your way.
Okay. So that's IGL, MGL, and SBI that we spoke about. Anything else, Jagannadham, that one should keep an eye out on?
And as a contrarian theme, we like this auto ancillary play. I think with this name Varroc Engineering from the auto ancillary is appearing to be quite attractive levels. The company is from the extended family group of Bajaj family, and they supply lighting and other products to Bajaj. And as of now, the dependence on Bajaj also reduced. It's now only 50% in comparison to erstwhile almost 100% dependence on Bajaj. And also in terms of the geographical distribution that this company has, India is only 33% dependency. Remaining 67% comes from US and Europe, meaning thereby even if we assume Indian auto is going through significant slowdown, there is enough geographical diversification to bail that out. And also after the IPO, the stock price has come down a good 55-60% from its highs. I think right now it is trading at barely 10 times P multiple FY21. We feel it makes a lot of sense to add this stock to the portfolio. We admit that currently auto is going through slowdown, meaning thereby auto ancillary upsides may be limited. That is from the 4 months point of view. But if you look from 4 years point of view, I am sure there is a lot of money to be made.
Okay. Thanks a lot for that, Jagannadham. Really appreciate you taking out the time this afternoon. So quite a few picks there from Jagannadham, Thunuguntla. Let's take a look at IT and what's been happening there. The top 3 Indian IT companies, that's Infosys, TCS and Wipro, have seen a sharp rise in employee benefit expenses in FY19 compared to the previous year. The 3 companies together have hired over 25,000 employees in the US itself, which have led to a rise in the cost. Let's discuss the possible impact of this with Sudhin Apte of Offshore Insight. Sudhin, thanks very much for taking out the time. An 18% increase in employee costs for TCS, 17% for Infosys and 10% for Wipro. I mean, we've been seeing that over the last few quarters at least. The employee cost seems to be weighing down on the financials. Do you see that continuing?
Yes. You know, I think before I reply, I must put a small point here. This percent growth in employee cost that that you just mentioned, they actually need to be sort of rationalized against the revenue growth also. So the actual growth in staffing cost as a percent of revenue, is slightly lower than the numbers that you talked about. Nonetheless, the costs are going. And, there are 4 reasons that we published recently as the causes for why employee cost is substantially going up. So point 1, that last 2 years especially, the sort of disruption of traditional offshore model is on a faster track. And you see that as the model changes, the onshore-offshore ratios are changing, and you have a little bit more number of people onshore. So that's a point number 1. Point number 2, offshore teams, but the pyramids are no more as broad as possible. See, earlier, when you get very large deals for app maintenance or infrastructure management, etc., you have an army of a junior. Now, when you get a digital project, the teams are small, and hence that, the leverage of a wider pyramid is not there in the engagement. As a result of that, for same revenue, you need a little bit more headcount. Point number 3, the type of work demands a lot more seniors. Be it domain experts, be it, the sort of a lateral recruit from the industry, etc. And as an outcome of that, you need a more senior for solution design, architecting, etc. And often, to make the situation a little worse, often, a lot of these resources are required on site. So those are the 3 primary reasons why the costing change we are seeing, or other employee cost change we are seeing. And lastly, I think, as I mentioned earlier, I always look at total employee cost as a percent of revenue. That number for us is also further challenging because, as the competition is changing, obviously the margins are dropping. And when the margins are dropping, the staffing cost as a percent of revenue goes further high. So there are the 4 reasons why I feel that the trend is there. And I actually don't see any reason to reversal of it or any change in any near future. When the market gets open and it gets competitive, some of these factors are going to happen.
So with this kept in mind, which of these 3 have a better competitive advantage? Because I believe TCS on its own has consistently been the top 3 recruiters in the US over the past 3 years, and they have that advantage there.
Yeah. So, see, the TCS, there are two advantages for TCS. One, as you already mentioned, that they had a very decent onshore presence for a longer time, for especially technical resources, not so much so S&M, but for technical resources, their onshore presence has been quite high for some good time. Though the profile has changed. Earlier, I think, one could call large chunk of onshore presence of TCS was more of a body shopping. That's changing to solutioning. But nonetheless, the percent of revenue, they always had a higher. So they in a way have a little advantage. B, I think that's a most leveraged company from perspective of automation, non-linearity, etc. internally. So as an outcome of that, if you really see number of people added per $100 million revenue, that number for TCS is attractive compared to many others. And especially how much that's growing. So these are the two reasons why I feel that TCS in a lot is fairly competitive, but the gap between they and Infosys isn't very wide. So I think TCS enjoys the lead, but Infosys once settles down with their issues, which looks like last 4 quarters, they settled with earlier management and employment or attrition related issues. Once that happens, hopefully Infosys can catch up and we'll see some industry level performance by the two.
Okay, so where does Wipro fit into this? Because amongst the three, I think Wipro's reached about 64% localization in the US, so there is more headroom there. And considering the tighter visa norms, entry-level positions are not being able to get transferred there. So it's mainly those high-cost employees that are there. So for Wipro, is it going to have a bigger impact if they spruce up localization further?
I think so. I think there are more complexities to Wipro's situation than what you talked about. I think Wipro has a growth challenge. Obviously their ability to convince the client to send the work offshore or think about solutioning is a little weaker. Also, Wipro, because of a somewhat lesser competitive advantage, is ending up into putting in a lot of bodies onshore, which otherwise they, maybe TCS or Infosys or Cognizant may say no to that work. Wipro is compromising because the revenue is not going anywhere substantially compared to the peers. So Wipro is a little bit a compromise position from the strategy, marketing, and go-to-market. So I do believe that Wipro situation is a bit complex, a little bit higher, and I really can't essentially say all of those are on a high-end work or things like that. So they basically are trying to get the work which comes in a way their way, and that is the reason why you see a heterogeneous even skill set onshore that Wipro deploys.
Got that. Sudhin, thanks very much for putting that into perspective for us. Really appreciate you taking this call. Quick look at IT as a pocket. Infosys, TCS, HCL, Tech Mahindra, all of these names, including a Wipro. In today's session, not much is happening, but that's probably the case for the rest of the market as well. But there has been a pickup from the lows of the day. For the Nifty, we are back into the green, and this is going to be the last half an hour of trade, so it's going to be interesting to see how expiry shapes up as well.
That's right. In fact, we did marginally slip into the red for a while, for a very brief period, but we are back above the mark of 11,850, and that's what the options data was indicating. The expiry could take place in that range of about 11,850 to about 900. Just want to highlight a few stocks. Tata Motors it's the top Nifty gainer right now, and of course it's been an underperformer. Let's not forget that. I don't know if it's a function of some bit of short covering which is taking place in the expiry day, but nevertheless it's the top gainer with gains of about 3 to 3.5%. Brijesh, on the charts at current levels of 166, would you take a bet on Tata Motors?
See, Navneet, the overall trend is not that much positive. No doubt we have seen stock bouncing from a recent swing low of 153 and now it has been quoting at 166. As a trader, one can play. So right now the trend is on a buy side. So suppose someone wants to play somewhere around, if it trades below 166, one can take a buy call with a strict stop loss of 161, and on the higher side resistance lies at 170 to 174 band.
Okay, that's the view coming in on Tata Motors. Technically, last 1 month, the counter is down about nearly 8%. Okay, time for us to slip into a short break. And as we slip into that short break, Lemon Trees opened a new hotel near the Mumbai International Airport today. The mid-level hotel chain has aggressive plans to ramp up its presence in the city. Mishka Parekh caught up with the company's CEO Patanjali Keswani to gauge just what's prompted the hotel to be so aggressive in its expansion plans. Listen in.
Bombay is an exceptional market, unlike most parts of India where there is high volatility in demand and supply. Bombay has generally exhibited very stable occupancies. So I think the average occupancy in Bombay is over 75%, and perhaps the occupancy of at least the hotels I know where we are located is over 80%. So now if you look at Lemon Tree, we have hotels which have stabilized, and we have hotels which are newly launched. So like, you launched 5 hotels last year. So if I take the group average occupancy, we are about 78%. But if you take our stable hotels occupancy, it is 81%. My expectation in Bombay is I would be personally disappointed if our occupancy is less than 90% within a year and a half. There are about 5 cities like Gurgaon, Delhi Airport, Hyderabad, Bangalore, and Chandigarh, where we typically do well over 85. In fact, we generally are over 90% occupancy. So certainly this market, which is the best in India, I would expect to have at least that level.
Okay. And what kind of project IRR and returns do you see coming in from this Mumbai property?
So we invested 325 crores to build this hotel. And our rough projection is that within 1.5 years, this hotel should make 60 crore EBITDA.
Also, is the management strategy of starting business hotels in other metros as well on track?
Absolutely. We have a very aggressive pipeline. We are currently, I think with this hotel, we have 5,800 rooms. We are opening another 3,000 rooms, certainly in the next 2.5 years. And typically, we add anywhere between 500 to 1,000 rooms a year in management contracts. So my broad guess is that, again, I would be personally disappointed if by FY21 we have less, FY22 actually, 3 years out, we have less than 12,000 rooms in our portfolio, which is roughly going to be about 20% of all mid-market hotel rooms in India.
Okay, so adding to that answer, what percentage will Mumbai contribute to the owned hotel rooms for Lemon Tree by 2022?
You mean in revenue?
No, in terms of rooms.
So Bombay currently, we have this hotel which is 300 rooms. We are waiting to open a managed hotel in Kalina in BKC, which is another 70 rooms. If we acquire Keys, for example, there is another 130 or 40 rooms about a kilometer away. Then we are building among the largest hotels in India, the Aurika next to the ITC Maratha at the International Airport, which is 670 rooms. So if you add this up, this is 1,200 rooms. But broadly, my internal target for Bombay is that by 2022, we should have a minimum, including signed, which means they may not have opened by then. We should have a minimum 1,800 to 2,000 rooms in Bombay as a brand, as a group of brands, Lemon Tree.
My last question to you, sir, an outlook for the next quarter for Lemon Tree as well as the hotel industry?
See, what I have seen is in the last 5 months, there was a triple whammy for demand in India. One was the elections, one was the gradual closure of seats by Jet Airways and the increase in prices in the seats by the other airlines, which kind of had an impact on movement of people. And the third biggest whammy I have seen is a general slowdown in some sectors like automobiles and automobile components, in NBFCs, which is financial services, in consumer staples and fast-moving consumer goods. These are all consumers of our hotel rooms, and hotel rooms are perishable. So if I don't sell it today, I'll never earn the money for that night. So there has been a clear slowdown, and this has started from February. I am seeing some pickup in this month and July. So I'm hoping that this is a very temporary impact. But on a secular basis, over the next year or two, I have no doubt that the hotel industry will do very, very well. But maybe a quarter or two will be affected by these, semi-black swan events.